Welcome, I'm Zach from Maddern Financial Advisers. I'm here today with the head of the accounting division at Maddern Accountants, Lisa Morgan. I'm also here with Mark Maddern, private client advisor at Maddern Financial Advisers. We're going to be speaking a little bit today about minimising your tax. Okay, Mark, so everybody's favourite question, how do I minimise my tax?
Very good question. One of the first things we need to do is to sit down and understand a little bit more about your unique situation. For example, your employment status. If you were a salaried employee, your tax minimisation strategies might be limited to contributions to superannuation and/or negatively gearing. Whereas if you own your own business, if you've got a family trust, or perhaps have the ability to salary package, there are other options available to you as well. One of the biggest considerations is actually one that's not well thought through by most people, which is disposal of assets. And that actually comes back to how do I physically purchase in the first place, what's my intention of the investment, and/or eventually what's the impact on disposal. And Lisa can talk in a moment just a little bit about tax structures.
All right, Lisa, so Mark's just mentioned about the importance of tax structures. How would I know which one's best suited to me?
You'd need to come in and make an appointment, and at that point I would need to know about you, what your goals and aspirations are, and then I can talk to you about the different types of structures. So the main ones you'd be looking at is whether you acquire an asset in your individual name, or if you are married in joint names, or if you are looking at a trust structure, and there's a number of trust structures, whether there's a unit trust structure or a family trust. There's also a self-managed super fund. I can run through the different income tax rates and where they apply, and also the capital gains tax effects. So you really need to make an informed decision up front and seek advice.
All right, thanks, Lisa. Okay, Mark, so I heard you touch on the importance of negative gearing earlier. What exactly is negative gearing?
Well, generally speaking, it's where your tax-deductible expenses outweigh your income. It's a common strategy that's used to decrease somebody's, say, taxable income, often on something like, say, a property. If I receive $300 a week for my rent, but I have to physically pay out, say, $400, the difference on those two is often coming off of my marginal tax rate. It's one of many strategies that we use to help try and decrease somebody's taxable income. It doesn't have to be just for property. You can use it on shares via warrants, margin lending and geared products. You can use it on property and a series of other investments. But the core takeaway point would be that with negative gearing, you want somebody to sit there and hold your hand through the process, weigh up the pros and cons and see if it's appropriate to you. To do that, you're best off just making an appointment to come and have a chat.
So a negatively geared investment in an individual's name is most likely to turn positive in a number of years, and then that can actually cause you tax problems. So tax planning and minimisation upfront with good sound advice is the way to go.
Fantastic, thanks guys. And thank you. If you'd like to learn more about tax minimisation strategies and how we can help you, you can contact us on 03 9999 7200, or alternatively, you can check us out on our website at www.maddernfinancial.com.au. Thanks for watching. See you next time.